The structure starts with the hardware.
iPhone 14, AirPod,
iPhone 15,
of Apple Watch,
iPhone 16,
iPhone 17.
And it begins the moment we make our first purchase.
You should expect that Apple's going to keep innovating, and you should jump on the train now, though. Okay?
Because once you buy the hardware, you're positioned for everything that sits on top of it. Businesses typically spend heavily to acquire their customers through ads, marketing, promotions, all in the expectation that you will pay for their product. But in the case of Apple, we pay to enter their system. The device itself is the acquisition cost, with over 2 billion active devices worldwide to prove it. And after that first device, the system's such where we start adding more. And the more we add, the harder it becomes to leave. Your messages sync instantly. Your photos, your passwords, your files, all intentionally designed to keep you locked into the ecosystem. And once you're locked in, then Apple activates the real revenue driver. Today, we're going to be breaking down Apple's business by following the cash. We'll start at the top, with how Apple generates revenue through services after their customers pay for the hardware, and then move into margins, operating efficiency, and free cash flow. Then we'll take a look at how that cash is returned to shareholders, and why it is that this system has made Apple one of the most successful and durable businesses in corporate history. And finally, we'll close with examining the risk that could put pressure on this entire system. But before we start, my name is Austin. I'm an accountant who used to work for a Big Four firm in their asset and wealth management division. And on this channel, I focus on teaching you how to actually understand what the numbers are telling you. With that context, let's begin. Once you have Apple's device in your hands, Apple continues to monetize the daily convenience of using their hardware. Your storage, music, apps, payments, all in the form of services. And this is where the real money is made. In 2025, Apple reported gross margins, which is a fancy term for profit a company keeps after subtracting the direct cost to produce the product, in services of 75%, compared to 36% for their product segment. This means that for every dollar in sales Apple earned, they kept 75 cents before operating expenses. And taking a look at the trend, we see continued growth in profit every year, known as margin expansion, from 64% in 2019 to 75% in 2025. Now, part of the reason that margins are so high for services and differ from products comes down to accounting. Specifically, the cost to produce that revenue, known as cost of goods sold. These are separate costs from operating expenses, which we'll cover soon, and involve cost to produce the product, or simply, in this case, inventory. Hardware products will necessarily carry a lot of physical inventory, components, logistics, assembly, etc., whereas the software segment does not. So not only are Apple's services physically lean, they're recurring. Yet total profitability is not measured by gross margins alone. Every business has day-to-day costs required to function: rent, utilities, marketing, payroll, etc., all known as operating expenses. As a company begins generating more revenue, operating expenses typically tend to scale alongside this increase. And if operating expenses scale faster than sales, profitability drops. But because Apple is lean, the opposite is happening. We see here that their operating costs are not skyrocketing year over year, showing that as revenue continues to grow, they are scaling efficiently, reporting an operating margin of roughly 32% for fiscal year 2025, with average operating margin over the past 5 years at roughly 29%. This stability is due, in part, to what's known as economies of scale. As the business grows larger, it has more opportunities to take advantage of cost efficiencies in its operational chain or supply chain. But this just provides context to the metric that, when we follow the cash, actually matters here: free cash flow. Free cash flow is the cash Apple has left after running the business and paying for capital expenditures. It's the money that Apple can use to pay down net debt, invest back into the business, and return to shareholders through dividends and share buybacks. And in 2025, Apple produced roughly $98 billion in free cash flow, down roughly 10% from the prior year. But if we take a step back and look at the past 5 years, cash flow jumps dramatically between 2020 and 2021. And when we smooth out the volatility, we see a compounded annual growth rate of roughly 6%. For a business as large as Apple, steady cash flow growth at this scale is exactly what smart money wants to see. But then you might be asking, what does Apple do with all this cash? Introducing the share repurchase program. A share repurchase program, or buyback for short, is when companies use surplus cash to buy back their shares, retiring them in the process. This effectively causes current shareholders to own a larger amount of the company's earnings. Pair this with a dividend, and it's an enormous way to return capital to shareholders. And in 2025, Apple authorized a massive share repurchase program, totaling $100 billion. And as of year-end, they have currently bought back $89 billion worth of shares. What's really interesting, however, is that Apple isn't just using excess cash to buy back shares. They're also issuing commercial paper, which are debt instruments, to do it. Apple is a AAA rated company according to Moody's, which is higher than the US government. And this means that they borrow money at extremely low rates. This borrowed money can then be deployed back into the share repurchase program. Equity investors typically expect a return of roughly 8 to 12% on average, while debt investors usually 3 to 5%. So in this case, Apple is using cheap debt to retire expensive equity. But as with anything, there is nuance here. Buybacks only create value when they're done at the right price. When a company repurchases its stock, it's effectively saying, we believe our shares are worth more than what the market is currently pricing them at. Basically, buybacks are a way to see how management views the company's true value. But the inverse here is also true as well. If management is buying back shares when the stock is in fact overvalued, they're eroding shareholder value. So buyback programs aren't automatically good or bad in and of themselves. It depends heavily on management, which then brings us heavily to our risks. Apple's services segment, particularly the App Store, has seen increasing regulatory scrutiny. In the UK, a London-based tribunal ruled that Apple abused its dominant position by charging app developers excessive and unfair commissions and shutting out competition in app distribution. In Europe, multiple civil rights groups have brought antitrust complaints arguing that Apple maintains monopoly power by controlling app distribution, payment processing, and how third-party software interoperates with iOS devices. And in the United States, the Department of Justice has filed an antitrust lawsuit alleging Apple has an illegal monopoly in smartphones. So what's the implication here? If regulators force changes to App Store fees, payment systems, or software interoperability, it could have a direct effect on the margins of Apple's services segment. And because services are a key driver of Apple's cash flows, those changes could have a direct effect on their strength. So when we take a macro view of this, the question then becomes, how resilient is Apple's business model if these pressures continue to intensify? Thanks for watching. If this breakdown was useful to you, then like this video and subscribe to the channel. There will be a lot more coming in the future, and I'll see you in the next one.